I legally paid under 9% tax last year and I'm an accountant. If you could cut your tax bill in half without breaking the law, would you actually do it? Most people in the UK are paying between 20% and 40% tax. And last year, I paid just under 9%. And no, I'm not hiding money offshore or doing anything dodgy. This is 100% legal. And the best part is you don't need to be rich and you don't need to run a massive business. Anyone who runs a limited company could do this, but hardly anyone does. And don't worry if you're not quite running as a limited company just yet, because even if you're still a sole trader, some of the principles can still be applied. And it's still very useful knowledge for when you do decide to become a company. So in this video, I'll show exactly how I did it, why it's legal, and why your accountant probably hasn't told you about this. But before we dive in, if you want to find out how much tax you're overpaying, then head to the link in the description box below to take my 60-second quiz and start saving yourself thousands of pounds almost instantly. Now you might be thinking, is this one of those tax loopholes that only accountants and super rich people know about? Well, it kind of is, but also not really at the same time. The crazy part is this strategy is hiding in plain sight. HMRC literally explains how it works on their own website, but they're not shouting about it. Most people miss it because they either don't have the right accountant or they've never been shown how to set the business up properly to take advantage of it. What if I told you that your tax bill could drop by thousands and you could be well on your way to paying just 9% tax just by claiming what you're already buying? I've got a mate who's a concreter, and the other day I asked him if laying concrete was hard, but he said it's easy as long as your prep work is good. This is the exact same situation that we're in here. All right, we're not laying concrete, but in order to give yourself the best possible chance of paying just 9% tax, you need to make sure that your prep work is on point. And in this case, it means getting your taxable profits as low as possible. But how do you actually do this? Well, I've got a client who edits videos full time, and last year he paid for Adobe, Canva, a new microphone, and even rented space in a co-working office. But when he sent me his expenses for the tax year, I was shocked to not see any of these costs on there. And when I asked him why, he said, well, I just assumed it wouldn't count. I swear I nearly fell off my chair. That was nearly £6,000 that he paid. And when I told him that he could have written it all off and saved loads of tax, he just stared at the screen like I told him he could fly. Here's what HMRC says. If you spend money wholly and exclusively for your business, you can use it to lower your profit. It might sound complicated, but here's a simple way that I explain it to my clients. If it helps you run, grow, or operate your business, then it probably qualifies. So whether that's your phone bill, software, training courses, home office costs, or travel and meals, putting everything like this down on your tax return will bring your profits down and get you one step closer to paying 9% tax. Every time you buy something for your business and don't claim for it, it's like leaving a £20 note on the floor and just walking off. You wouldn't do that in real life, but people are doing it in their business every single day. So let's say you've got £10,000 of expenses. If you claim for them, your taxable profit will drop by £10,000. And if you're a limited company, that's £2,000 of tax saved. And if you're a sole trader, that's up to £4,000 saved. Most people treat their limited company like an old school piggy bank. They crack it open, take everything out, and then wonder why their tax bill is so high. But when your company makes profit, that money belongs to the company and not you. And here's where most people go wrong. As soon as the business earns money, they take out every last penny. But every time you take money out, HMRC has got a big smile on their face because you've just earned yourself a tax bill. And the funny thing is that if you were to put that money back into the company, let's say for instance, you want to invest in some new equipment, then you then don't get that tax back. So you might have paid tax on that money for no reason at all. Leaving money in your company gives you flexibility, lets you reinvest in the business, helps you build reserves in case something goes wrong, and most importantly, delays personal tax until you actually need the money. Delaying the income can also be massively strategic, as it allows you to split your income across multiple years in order to make full use of your tax-free allowances. This is just another strong step towards paying just 9% tax. Now let's get into the real nitty-gritty of how you can pay less tax than you ever have before. A mate of mine hit 6 figures for the first time and then watched nearly half of it disappear to tax. Meanwhile, I was earning less, but I was taking home more. And he thought I was joking. There was only one key difference between our two businesses, and that was the setup. I was a limited company and he was a sole trader. When you earn money as a sole trader, everything you make is taxed as income. It all gets lumped into the same pile and then pushed through the standard income tax bands, which are 20% all the way up to 45%. And the worst part, you're taxed on profit, not what you actually take home. So even if you leave some money in your business bank account, you still pay the full amount of tax on that money. But if you're running for a limited company, then it works completely differently. And this is where things get interesting, because I realized that I could choose how I got paid, not just blindly accept what HMRC tells me to do. So here's the setup. As a limited company director, you should pay yourself a salary of £12,570. And this takes full advantage of the personal allowance, so it means you pay zero tax on this amount. You then want to take the remainder of your income as dividends. You might be sitting there wondering, well, what actually are dividends? Well, you can think of them like a thank you payment for owning part or all of your company. But why are they better than just paying yourself a normal salary? Well, with dividends, you don't have to pay national insurance, so you save an employee NI of 12% and then employer NI of 14%. They're also taxed at much lower rates than salary. If you keep yourself in the basic rate tax band, which would mean paying yourself £38,000 in dividends, then you're only going to pay 8.75% tax. Even if you do creep into the higher tax brackets, you're still paying around 7% less compared to salary. So let's say your business made £60,000 profit. If you have a limited company, you'll pay around £12,000 in tax. When we compare that to a sole trader, you'd easily be looking at least £20,000 in tax and national insurance. So you're saving around £8,000 just from how you're structured. Having a limited company gives you control over how and when you take your income. And if you're a sole trader, unfortunately, you just don't have that flexibility. But switching to a limited company might make sense once your profits hit between 30, 40K and above. And making the switch could literally save you thousands of pounds. That being said, it's not always better to have a company. There are additional admin costs, accounting fees, and compliance obligations. So make sure you get advice before you jump in. So now you know how to pay under 9% tax. This is actually completely useless because there is a way for you to take money from your company and pay 0% tax. So watch this video right here if you want to find out how.